It's a classic story of feast and famine. Microsoft has been on an absolute tear lately. They recently reported their 2023 earnings, where they reported record profitability. The law of big numbers make it incredibly difficult for a company with over $200 billion of revenue to grow 13% in a single year. The company is growing like wildfire despite almost being 50 years old. Contrast this with Disney, who just celebrated their 100-year anniversary. You wouldn't know that based on the mouse being stuck in the woodshed getting beaten right now by the stock market. But there is an activist investor, or corporate raider depending on who you ask, named Nelson Peltz, who may have the tools necessary to help Disney or get them deeper into trouble. In this video, we'll analyze both companies. This is a classic battle of momentum investing versus a value buy. Or if we were to take a more bearish statement, it's a classic battle of a fully priced stock versus a value trap. We won't get biased until we actually look under the hood for both companies. Let's start with Microsoft. I think most people will hang their hats on the main reason for Microsoft's most recent pop in stock price is due to the AI hype cycle. The PE ratio, or price to earnings ratio, represents how much the market is willing to pay for a stock. If we look at their current PE ratio down at the bottom right of the screen, next to my lovely face, we can see that their PE ratio is 34 at that time. It's not a flank feature yet, but we may build it into the product. We can go over to see what the historical PE ratio has been, and it's been floating around, it is higher. They announced their AI partnership right around this time period, and now the market values the stock more. So yeah, this is concerning to me. I don't like to buy fully priced stocks. And so if we wanted to look at a valuation on this, we would have to look at how they're growing revenue. We could do a discount cash flow analysis to see if that multiple held true 5 years in the future and they kept growing their revenues at about the same rate, what the value would be and if it would beat the market. But yeah, this jump from about a 26 PE ratio to a 34, this does represent that the market is baking in the AI hype cycle premium into this stock. However, if we actually dive into their earnings reports, we can see that their cloud business grew at 28%, but well above their internal goal of 25%. This rolls up to the intelligent cloud business, which overall was up 17%. Intelligent cloud includes, as you can see by looking at their segment results of operations, that intelligent cloud was their largest grower and their most profitable segment, and that has increased pretty substantially. With all this being said though, I do think the company is running a bit hot lately. I wish I would have purchased this company at the beginning of the year when the OpenAI deal was first announced. But if earnings continue to grow at the same rate, I do think that next year Microsoft will be worth more than it is currently worth. I don't know if it'll outpace the market, and that's why we're here. We want to beat the market. These could be choice words. Integrating AI into their Office suite could change everything, and I could be regretting these words. But you know what you wouldn't regret? Subscribing. I have like 20 subscribers right now. The videos are getting better. Look at this light. It's burning my eyeballs out, but I'm doing it for you. I'm just kidding, I'm doing it for me. But if you like what you're seeing, please like and subscribe. It really would mean a lot. Let's move to Disney. All right. Big week for Disney. They're reporting tomorrow. I'm recording this on Tuesday, November 7th. But tomorrow they report their end of year results, and I'm really excited to read their earnings report because there's a lot going on. And as I was researching them for this company, I got more and more excited about what's coming. Not necessarily bullish, but I think it's an interesting case study nonetheless. So what's going on? All right, almost a year ago, Disney's long-term CEO, Bob Iger, returned after his hand-picked successor, Bob Chapek, or Bob 2.0, had been ousted after a slew of scandals and poor performance. I was a huge fan of Bob Iger and was really excited by this news. He led some of Disney's biggest moves, namely the acquisition of Pixar, Marvel, Star Wars, Lucasfilms, 21st Century Fox, that last one's not too good, as well as development and rollout of Disney+. In 2019, he released a memoir called The Ride of a Lifetime, and it was a great business book. I learned a lot. But his return so far has been marked by underperformance and tone-deaf remarks. This is where it gets interesting, and enter Nelson Peltz in his open letter to shareholders, urging them to vote to put Nelson Peltz on the board of Disney. So this is what's known as a proxy battle. Cleverly named this report Restore the Magic. As always, when you read financial reports, there's legalese in the beginning, and they're just proposing why Peltz should be voted. But then when we actually get to the letters, so the reasons to vote for the Trian Group's nominee, this is where it gets a little bit interesting. So they're basically saying that Disney stock has underperformed the S&P 500 for a couple of years, especially like their EPS going down over the last 2 years. This is exciting. This is the stuff that you should get, that should make you excited when you're looking at companies. What are they mad about? Mad about poor corporate governance, which over-the-top compensation practices, which I appreciated because of Bob Iger's reported salary and his less than choice words that he gave to the Writers Guild while they were on strike, as well as SAG-AFTRA. Failed succession planning, also a great point. Bob Chapek, Bob Iger's successor, was handpicked by Bob Iger himself. Minimal shareholder engagement. Again, as someone who's trying to create a platform that connects companies to businesses, this is exactly, I'm preaching to the choir. Nelson Peltz is preaching. A poor strategy and operations, their flawed DTC rollout, and they have a great point here, basically saying that despite having the same revenues as Netflix and a significant IP advantage, their multiples, their profitability is horrible. Like overall cost discipline, leading them to actually have negative net income this year. Over-earning in the parks, and then they're basically over-earning, I think that they mean is kind of overcharging in the parks to subsidize those streaming losses. Ask anyone I've talked to who's been to Disney World in the last couple of years, has not loved the experience because they feel like they're just getting milked for everything they earn. And then poor capital allocation, basically saying that they've loaded up on a bunch of debt to make these purchases of 21st Century Fox, Pixar, Marvel, etc., and the elimination of their dividend, which they had been a dividend aristocrat for a while. So here's what Nelson Peltz thinks he can do to fix Disney. He wants to develop a succession plan, align compensation with performance, improve the DTC operating margins, eliminate redundant and/or excessive costs, refocus the creative engine to drive profitable growth. These are all things that I completely agree with. I don't really care about a dividend. I'm a growth investor. And they say exactly what they're looking to do, what they are and aren't pushing for. Again, this is the company trying to make the actual shareholders, the voting class of the company, vote in a specific way to force the company to do something else, which is why it's called corporate raidership, or activist investor if you want to take a more positive look on it. So they're not looking to replace Bob Iger, not looking to break up Disney. There's been a lot of rumors, and we'll talk about this soon, about a possible Apple acquisition or a complete divestiture of ESPN, ABC, everything else, going on a yard sale. Not advocating to increase financial leverage, obviously, and the other ones are kind of just redundant, but they do say that they are for a couple other things. They are for a succession plan, reinvigorating the Disney flywheel, for an orderly deleveraging, for driving efficiencies, read layoffs, unfortunately, ensuring that customers get the best experience. And they go into a little bit of background here. The rest is, again, some legalese, and it gets into some pretty specific and esoteric details that we won't cover here. But honestly, I don't even want to say that if you're looking to invest, you shouldn't necessarily read all this. Maybe skim over it. I will give you I will give a link in the description. If you're going to invest a lot into it, you want to read. But if it's a small investment, a lot of it's legalese and not really for the point. You just got to know if the proxy vote passes, that's what Nelson Peltz is going to do. And if it fails, who knows? All right, some other things going on at Disney. Like I talked about earlier, there's possible chatter for a total buyout of Disney from none other than Apple themselves. I'm not sure about the probability of this happening. Apple, despite its massive market cap, they differ from other mega cap tech companies in that they don't really buy other companies. In fact, when I was looking at their historical acquisitions, I had to look all the way back to 2014 to find a familiar name that was acquired, and that was Beats by Dre. So the track record doesn't really support this theory, but the companies do have a really long history of working together. This started back when Iger purchased Pixar from Jobs back in 2006. After that, Steve Jobs served on the Disney board of directors until he died in 2011. But then Iger joined Apple's board right after that. He did resign back in 2019 when Apple announced that they were pushing into the streaming business. And we have no reason to believe that the companies are splitting apart. Apple itself is growing closer to Disney. During their keynote and announcement for the Apple Vision Pro, Bob Iger appeared on stage with Tim Cook, during the keynote when they announced their new headset, and this acquisition does make sense. You can see this keynote with the headset is rife with Disney content, including content from ESPN, National Geographic's, Disney's own IP, Star Wars, etc. So they really could populate their metaverse with Disney content if they acquired fully. I kind of doubt this will happen, but I could see this being a really good licensing model for Disney. And then the last thing I want to talk about what Disney's been up to is their total ownership of Hulu. They just recently announced that they were going to buy out all of Hulu. And this is exciting to me because Bob Iger has signaled that continuing into streaming and making it more efficient is one of their key drivers to get out of the hole that they've dug themselves into. I think this is a pretty compelling offer. I do like that I do like this acquisition, although I would like to see them sell some of their linear television business segments instead of using debt with the current interest rate environment. I think this may be in the cards because they recently broke out in their last quarterly report the performance of ESPN, which wasn't too good, but that could be signaling to the street that, hey, this asset is on sale. So yeah, we'll see what holds. There's a lot in the air, and there's a lot of uncertainty. I wouldn't be surprised that if in the next couple of weeks we see a major swing of the stock, either to the either up or down. But I'm watching, and I'm starting to sharpen my pencil on their financials, and I will be reading their annual report pretty thoroughly. This is probably the closest I've gotten to an investment. So we'll see where this goes. Thanks so much for watching. We'll catch you next time.